Radar, and the next corporate is waiting for us. Mphasis earnings, well, they have been taking positively. The stock is up close to around 4%. We're now joined by Nitin, Rakesh, the Chief Executive Officer, and Aravind, Viswanathan, the Chief Financial Officer on the show. Good morning, gentlemen, and congratulations on a good showing in the past quarter. The Q1 performance itself was good. It was better than expected. You're talking about outbeating the industry growth as well, and also steady conversion of the TCV to revenue. You're saying that you'll outpace the industry growth. Do you want to put a number to it?
Again, we called out kind of like a 2x to industry growth number right now, and it's driven mostly by our own, order book as well as pipeline. I mean, we had a record order book quarter in Q1 at 760 million net new deals, which is about over 100% YOY, and we had 390 million last quarter. So I think the pipeline had been building up for the last 2 quarters, and we're glad that we were able to convert that into actual deals, and some of that translated into revenue growth within the quarter, as well as gives us a little bit more visibility over the next couple of quarters. So I think that's what's driving it. We are pegging it to 2x at this point. Last quarter, we had called for above industry. So I think the confidence really comes from the ability to look at what the order books holds and what the pipeline holds.
What about the macros? Are they improving on ground?
About a year ago, we decided that in an uncertain macro, we have to focus on the micro. What that really means is if we have the right propositions, if we have the right client needs identified, and if we take a very in-client, account-specific, deal-by-deal approach, we should be able to find a way to at least continue to grow the business despite the macro being what it is, because we can't control the macro. But coming back to your question...
last time you had said that you're focusing on smaller deals, right? Not going after the big ones, and there is enough action happening. Maybe I'm not characterizing it correctly, but my point is you're kind of sort of looking at not the mega billion-dollar multi-year kind of things, but there's enough happening in terms of smaller size deals. And we have some numbers that in the pipeline, 68% of the deals are AI-related. This is AI, applying AI, sort of implementing AI, like generative AI across clients, or something else?
I think when we said that we are focusing on large deals, for us, a large deal is 20 million or above. Even in Q1, we have 4 large deals, 3 of them over 100 million. I think that's kind of a very good sweet spot for us to operate in the 50 to 200 million range. And there is a bunch of deals in the pipeline even today that qualify for that. So just making sure that small deals don't necessarily mean $1 million, $2 million deals. On AI-led pipeline, this is a combination of a few things, right? As clients have gone through the last 2 years and looked at the ability to actually use AI to impact their tech and their operations, now there is a pretty strong appetite and a top-down push to make them more enterprise-wide, whether it is applying AI to get productivity, contact center transformation, developer productivity, applying AI to see how they run their operations, both tech and ops, claims, underwriting, support, production support, maintenance, IT help desk. So this is really, for us, it's more about applied tech. We are not going out there and building new LLMs because that's not what we need to do. There are enough and more available for us to apply. So this is really more about infusing an element of tech orchestration and bringing them together with people to deliver a solution that provides that value that the customer is looking for.
Nitin, hi, morning. So, I wanted to come to the margin picture and what this infusion of AI means for margins. And then there are other sort of factors which maybe Aravind can talk about, which are impacting margins. You've been holding, fairly comfortably around the 15% handle. But going forward, and this is not a question only for, the next quarter, but say over the course of the next year and a half, what will this greater AI integration mean for your margins?
Again, I think it's a little bit too early to tell. We are still in early stages of adopting a lot of these solutions, but there's definitely some play that gives us the ability to infuse a platform or codify our solution into a set of repeatable tools. That definitely gives us a little bit of an operating leverage that we can use to either pass back to the customer, get more competitive. So we don't need to really drop our margin to win a deal that is a $100 or $150 million deal. So I think that's established over the last 2 or 3 quarters because you just called out the fact that we've held our margins quite tightly. Whether that gives us the opportunity to expand margins over a medium to long term, I think we'll address that as we get a little bit more comfortable with scaling these deals across multiple customers.
Okay, that's an interesting point that you make over there. And we'll watch out for this. So if AI can actually be margin accretive, because there's a contrarian argument that if it just increases productivity, then shouldn't it drive costs lower? But on the other factors impacting margins, Aravind, I mean, general competitiveness in deals, wage costs, and the overall operating costs. Are you comfortable and confident of keeping margins here? Is there any scope of improvement in margins ex of AI?
We kept our margins flat, and let's say for the quarter gone by, we kept it at 15.3, largely driven on the back of significant improvement in utilization, which kind of compensated for some amount of client-specific investments and AI-specific investments that we've been doing, right? So from a range standpoint, what we've kind of said is that we would operate between the 14.75 to 15.75% range. And we are probably right bang in the middle of that. I don't see a reason for a big change. Obviously, like Nitin said, as we ramp up these deals and as we win more, it'll be important to see how we navigate. I don't think the traditional levers are going to swing it too much. But obviously, AI would be something that would be interesting to see how it plays out from a margin standpoint.
Very, very quickly, Nitin, you said about there are two parts: AI work, which is orchestrating AI, which is new work, and then there is using AI to do your existing work, bread and butter work. So the latter is deflationary, the former we don't know. But this agentic AI, you think it'll impact AI orchestration work itself, because you'll have these AI agents orchestrating all that? You think it'll be a big disruption very quickly?
I think to us, the value stream of AI actually cuts across. If you look at the stack that the enterprises need to build, and there's definitely an AI engineering element to that, we are actually calling it the Mphasis AI Superhighway as a solution. What that really means is you need to create an environment where you have the ability for an enterprise to be able to offer these services to the internal users, for them to be able to build AI applications on top of. So I don't think that can be disrupted by agentic AI, because that's an engineering exercise. It can be done efficiently using AI agents, but it requires an element of design, it requires an element of governance, and an element of execution that cannot be fully automated using these agents. Applying agentic AI or generative AI to existing solutions, you can call it deflationary, but I think the way we look at it is that it's unlocking deals that were probably not conducive to ROI because they were either too expensive, took too long, or had too much risk. So it's actually opening up a new addressable market, even in existing book of business.
All right, Nitin and Aravind, thank you very much, both of you, for joining us. Good speaking with you guys.